Most people want to invest, but they are overwhelmed, stressed by market swings, and afraid of getting it wrong. The truth is, long term wealth isn't built by picking the perfect stock. It's built with a simple solution that works quietly in the background. In this video, I'll show you exactly how ETFs do that and how to build smart ETF portfolios for different age groups, including gold and silver for true diversification. Welcome back to Wages to Wealth. I'm Hitender, and by day I work in credit risk at a major retail bank. My job is to ensure that the bank has enough money set aside if things take a turn for the worse. So for me, it's all about managing risk in a strategic and sustainable manner. If you watched my Wages to Wealth introduction episode, you'll remember one key message from there. Real wealth isn't built by chasing one winning idea. It's built through diversification and discipline. ETFs are one of the cleanest ways to apply that philosophy in practice. So what is an ETF? An ETF, or an exchange traded fund, is simply a basket of investments that trades like a stock. Instead of buying one company, one country, one sector, you buy hundreds of them or even thousands of assets all at once. That's diversification by design. The same principle I talked about in the Wages to Wealth introduction, but applied in a practical and investable way. ETFs work because they remove emotions and predictions. Situations like the recent US-Venezuela tensions around oil and sanctions and the entire US-Greenland situation should remind you that markets are shaped by unpredictable global events, which is exactly why diversified ETFs, including bonds, gold, and silver, matter. First reason why ETFs work: diversification. Risk is spread across countries, sectors, and currencies. Second reason is low cost. Most ETFs cost around 0.05% to 0.25% per year, far cheaper than active funds. Third reason is transparency. You always know what you own. Fourth reason is long-term performance. Over time, broad market ETFs outperform most stock pickers. That's why pensions, insurers, and institutions rely on ETFs as their core holdings. Before we look at portfolios, let's cover the core ETF building blocks that we'll cover in this video. 1. Global equity ETFs, which is your growth engine in your portfolio. Some options are the Vanguard FTSE All World ETF, VWRL, the income option, or VWRP, the accumulating option. Another good option is the iShare Core MSCI World, IWDA is the ticker symbol. These give you exposure to 3,000 to 4,000 companies globally, and it's the backbone of any long-term portfolio. Second is the emerging market ETF, which is your growth tilt in your portfolio. A good option is iShare Core MSCI Emerging Markets, EIMI ticker symbol. This adds exposure to faster growing economies like India, China, Brazil, and increasing your long-term growth potential. Next is bond ETFs, which is your stability layer within your portfolio. A good option is the iShare Core Global Aggregate Bond, AGGG. Bonds will exist to reduce volatility in your portfolio in periods of market downturn. Next is gold and silver ETFs, which is your diversification and protection within your portfolio. This ties very well to the 2 episodes on my channel. In the intro video, I explained why diversification beyond equity matters, and in my dedicated silver episode, I broke down why silver deserves your special attention. So gold ETFs is your defensive hedge against inflation. A good option is an Invesco Physical Gold, SGLP ticker symbol. And then silver ETFs, which is more volatile and has higher upside. A good option is the Invesco Physical Silver, SLVP is the ticker symbol. Gold tends to protect your wealth, and silver adds industrial demand and volatility, which is why, as discussed in my silver video, position sizing matters a lot here. One of the biggest mistakes that investors make is using the same portfolio at every stage of life. As I've said since the very first Wages to Wealth episode, strategy should change with time horizon and not headlines. Before we get into the suggested portfolio breakdown, I want to reiterate that this is not investment advice and you should do your own due diligence and consult a professional if you need to. So let's get into the suggested breakdown by age group. If you are investing for your children, they have very long time horizons, typically 35 to 40 years. So the goal here is maximum compounding and risk tolerance can be very high. So suggested allocations could be 85 to 90% global equities, 5 to 10% emerging markets, 0 to 5% bonds, and an optional 5% in precious metals like gold and silver. This is pure compounding. Short-term volatility is noise at such long time horizons. Now, if you're in your 20s, this is the aggressive growth phase. Time horizon is around 30 to 40 years and the goal is growth over stability. So your suggested allocation could be 80 to 85% in global equities, 5 to 10% in emerging markets, 5 to 10% in bonds, and an optional 5% in gold and silver. Your income over here absorbs your risk and the portfolio can stay aggressive. Now, if you're in your 30s, this is growth with risk control. Time horizon is around 20 to 30 years and the goal is balance, growth and stability. Suggested allocation could be 70 to 75% global equity, 5 to 10% in emerging markets, 15 to 20% in bonds, and 5% in precious metals like gold and silver. This is where diversification, something that I've stressed in the channel introduction, really starts to matter. If you're in your 40s, you want to protect what you have built. Time horizon is around 10 to 20 years and the goal is capital protection and steady growth. So your suggested allocation could be 60 to 65% global equity, 20 to 25% bonds, 5 to 10% in precious metals, mostly gold, and a smaller silver allocation. This stage is about managing downturns and not chasing excitements. So how to invest in ETFs in a practical manner? 1. Choose a low-cost platform such as Trading 212 or Invest Engine platforms which both offer commission-free investments. Second, use tax shelters like the ISA in the UK or 401k in the US. Third, invest monthly. I cannot stress enough how important it is to maintain consistency here. 3, balance per once every year. And 4, stay invested. Most investors fail because not of bad ETFs, but because they abandon diversification under pressure. ETFs aren't about getting rich quickly. They're about building wealth quietly, consistently, and sustainably. The core message behind the Wages to Wealth from day one. If you want to go deeper, watch my silver investing episode for the full silver story and revisit the Wages to Wealth introduction to understand the diversification mindset behind everything that I've spoken today. Let me know in the comments, have you invested in any of the ETFs mentioned in this video? If you found this video useful, please hit subscribe and share with your network. I'm Hitender and let's turn those wages into wealth. See you in the next one. Thank you for listening.